Real estate investment trusts, or REITs, are a great way to add real estate exposure to your portfolio. Granted, owning real estate is a great long-term investment, but if you own and decide to manage those properties on your own, a lot of headaches can come with it. Some great alternatives to add real estate exposure to your portfolio could be through crowdfunding sites like Fundrise that I know a lot of people that use and like. The other alternative is REITs. REITs are great because you are investing in the company that already owns an array of different properties, so it instantly diversifies your real estate exposure immediately. You are buying into a company, essentially becoming an owner, and entrusting in the management team to deliver higher revenues, higher cash flows, with the hopes of higher returns and growing dividends. If you recall, REITs must pay at least 90% of their taxable income back to shareholders in the form of dividends. This is one reason why you see REITs typically having a higher dividend yield. Today we are going to look at 3 REITs that are trading at very cheap valuations, and the other part, they all have dividend yields north of 4%. Let's jump in. Hey everyone, Mark here, back for another video. If you are interested in even more dividend content, then definitely subscribe to my Dividend Investors Edge newsletter that goes out each and every week for my take on the market, a look back on a recap, and a look forward on what's on the horizon and some important things to look out for investors. You'll also get dividend news, and as a subscriber, you will receive 2 to 3 individual stock analysis that you'll receive straight to your inbox each and every month. I will leave the link to that newsletter down in the description below. Also, if you are looking for a great new investing platform, then definitely check out Webull. Right now they are running a very special promotion where you will get 12 free stocks valued up to over $30,000 for just opening an account and depositing any amount of money. You could simply open an account and deposit 1 penny if you wanted to and get those free stocks. So definitely take advantage of that quickly. Link will be down in the description below. All right, now back to REITs. I love REITs not only for the real estate exposure that I get, but also because they are a total return investment. Did you know that over the last 20 years leading up to the pandemic, REITs were the best performing asset class in terms of total return, easily outpacing the S&P 500. With that being said, let's dive into these 3 high quality REITs that are trading at a very cheap valuation. The first REIT that we're going to look at today is Store Capital, stock ticker STOR. Store Capital is a net lease REIT in the retail sector. And if you're not familiar with what net lease REITs are, these are one of my favorite types of REITs. What net lease means is they are a landlord, but many of the typical landlord costs, think of insurance, think of property taxes, think of maintenance costs. All of these are passed on to the tenant, where really Store Capital will just own these properties and collect a rental check, leaving many of those costs for the tenant to deal with. Store Capital in many aspects is set up very similar to that of Realty Income, stock ticker O, which has really been the gold standard, especially for net lease REITs. They operate in the same sector. They have a lot of similar tenants as well. But one thing that's different, Store Capital is trading at a much cheaper valuation. Where Store Capital likes to differentiate itself a little bit is by focusing a little more on middle market. They have cut out a niche for that, for middle market tenants that may be investment grade, but their market caps aren't big enough and haven't been graded by many of the large credit bureaus. What this does is it allows for higher growth, not only annual growth, but larger lease spreads as well. A lot of the transactions that Store Capital does are called sales leaseback transactions. And if you're not familiar with that, I'm going to go through that in 1 second. Do not be worried. I'm going to try and break this down for you in simple terms. So what a sales leaseback is, say we have tenant A. It's going to be a future tenant. We do not own the property right now, but they want to free up capital. They own their building right now, but they say, hey man, if we can sell our property, but we want to stay in this property, we don't want to move. If we can sell it to a landlord and then have them lease it back to us, that will not only free up all the capital that we have stored in this building, but it'll allow us to stay in this building and continue operating as if nothing changed. So this allows Store Capital to go to these tenants, these future tenants, an inside look at how the tenant, this future tenant, is performing and their guidance looking forward. So it gives them an inside track on which tenants are safe and which tenants we don't want to deal with right now. So if they get the thumbs up from their acquisitions team, then they go and purchase the property and they lease it back to the same exact people that they bought it from. That there, in a nutshell, is a sales leaseback transaction. Now in terms of Store Capital shares. On the year, Store Capital shares are down roughly 20% and down 25% from its 52-week high. The company has gone through a lot of change in 2022 with the abrupt resignation of the former CEO and co-founder Chris Volk, someone who I have had the opportunity to interview and speak with on a number of occasions. Naturally, I had my doubts about the company when I first heard the news, but this is due to how brilliant Mr. Volk has been. However, Store has been firing on all cylinders and just reported a very strong quarter in the middle of an economic slowdown. Here's a look at the company's top 10 tenants. You may notice some names on there, but it is a very broad group of tenants, and these top 10 make up 17.7% of the annual base rent. On the right side, you'll see the top industries the company is invested in. Full-service restaurant make up 6.9% ABR, followed by early childhood education, which makes up 6%. The top 10 industries as a whole make up 47.6% of annual base rent and accounts for 2,052 properties. Looking at this slide, you can see how the entire portfolio is broken out into three segments. Service being the largest and accounting for 64% of total annual base rent, followed by manufacturing at 21%, and service-oriented retail accounting for the remaining 15%. In all, Store Capital has 3,012 properties. These properties are spread out all across the U.S. with a strong presence in Texas. One of the great things about investing in net lease REITs, especially ones like Store Capital, is due to the vision that investors can see going out years. If you invest in a company like, say, Microsoft, they usually give 1 quarter guidance or maybe the full year guidance. But with REITs, you get a good idea on how cash flows will look moving out 5, 10, even 10 plus years due to these long-term leases that they enter into. And you can see what the annual lease step-ups are each and every year, which gives investors a great vision into where these cash flows will be 10 plus years down the road. Many REITs have these long-term leases with these built-in rent escalators. Some of them are fixed, some of them are tied to CPI or inflation with a cap on that. Store Capital right now has a weighted average lease term of 13.2 years with an average annual lease step-up of 1.8%. This means, on average over its entire portfolio, tenants will see a nearly 2% rent increase each and every year. The portfolio as a whole right now has a 99.5% occupancy rate, which is quite impressive. All in all, the company is a fabulous one, and the new CEO, who happens to also be a co-founder, has done a very fine job in her short stint so far. Turning to valuation, shares of Store currently trade at a price to AFFO of 12.3 times. Remember, with REITs, we do not look at EPS. Instead, we look at AFFO, which is more in tune with cash flows. Analysts are expecting AFFO of $2.30 in the year 2023, which equates to a forward multiple of 12 times. Now, compared to over the past 5 years, Store has traded closer to an average AFFO multiple of nearly 17 times. This is an incredible discount you're looking at for an incredible company. Shares of Realty Income, for comparable purposes, are trading at 18 times. Right now is a great opportunity for investors to accumulate shares at these low levels and wait. Store currently pays an annual dividend of $1.54 a share, which equates to a 5.6% yield. Over the past 5 years, the dividend yield has been roughly 4.6%. That dividend is plenty safe with the low payout ratio of 69%. The second REIT that we're going to look at today is National Retail Properties, stock ticker NNN. National Retail Properties currently has a market cap of $8.1 billion. This is also a net lease REIT, very similar to that of Store Capital and Realty Income. Remember, a lot of those typical landlord costs, insurance, property tax, maintenance costs, all of those are passed on to the tenants. On the year, shares of National Retail Properties are down only 5%, but has seen a lot of positive momentum since bottoming out with the greater market in mid-June. Shares have actually rallied nearly 12% since that time. Given these inflationary times that we're in, the strong tenant base that National Retail Properties has, and this valuation that we're going to look at in a moment, makes for a great time to start accumulating shares in a company like National Retail Properties. This company has stood the test of time. In fact, they went public the same time that Realty Income went public back in 1994. So they have stood in the shadow but been performing quite well over the years. Both of them went public at the same time. Both of them are net lease REITs. Both of them operate in the retail sector, and both of them have very strong dividend track records. But both REITs are trading at drastically different valuations. Let's first take a look at the portfolio for National Retail Properties. The portfolio currently consists of 3,305 properties within 48 states. These are leased out to over 380 different tenants. As of the second quarter, the portfolio had an occupancy rate of 99.1%, which again is very impressive. Now here is a look at the top tenants. You'll see some names like 7-Eleven, Mr. Car Wash, Camping World, LA Fitness, and GPM convenience stores to round out the top 5. These top 5 tenants account for over 20% of annual base rent. Many of these tenants and industries here are able to perform in any given economic backdrop, which speaks to the defensive nature of this particular REIT. Many of their tenants, given that they are in the retail sector, however, are shielded from the threat of e-commerce. This again speaks to the defensive and the consistency from the company. Over the past 25 years, shares of NNN have averaged an annual total return of 12%. Similar to Store Capital that we just looked at, National Retail Properties also enters into very long-term leases with rent step-ups every year. They do not focus as much on investment-grade giants like Realty Income, but by doing this again adds slightly a little more risk, but also gets better pricing, higher cap rates, and strong rent growth. The company also maintains a very fortress balance sheet with a credit rating of BBB+ and a weighted average maturity on that debt of 14.5 years. Just look here at the company's historical occupancy rate by year with an average over all of these years of 98%. Now for the dividend. On this channel, we speak a lot about dividend growth, a major focus of mine, and utilizing the power of compounding dividends. That is exactly what National Retail Properties has done over the years, with a history of rising dividends for 32 consecutive years and counting, third longest among all public REITs. Currently, shares of National Retail Properties pay an annual dividend of $2.20 per share, which equates to a dividend yield of 4.8%. So another high yield here. The AFFO payout ratio is below 70%, meaning the dividend is not only safe, but still has plenty of room to keep growing. All great signs of a well-rounded company. In terms of valuation, the company trades at an AFFO multiple of 14.5 times. Analysts are expecting an average AFFO for 2023 of $3.25, so looking on a forward-looking basis, that equates to an AFFO multiple of 14.1. Now let's compare this to the 5-year average, which is 17.1 times. The final REIT we will look at today happens to also be the largest REIT, and that is Simon Property Group, stock ticker SPG. Simon Property Group currently has a market cap of $39.3 billion, and they are the largest mall landlord in the US. Now I already know what you're thinking. Malls are dead, retail is dead, e-commerce is taking over, and the economy is going into a recession. All high quality, well thought out ideas when thinking of a company or a stock like Simon Property Group. However, Simon Property Group is unlike any other mall landlord that is out there today. Again, Simon Property Group is not only the largest mall landlord, they are also the best and most efficient mall landlord for years to come. They have been through all of these market downturns, recessions, and have come out of it stronger. Now going back to those ideas, remember, we are here focusing on the long term, and markets are a forward-looking index. They look out 6+ months. So maybe, just maybe, could all of this already be priced in? After all, the stock has had an amazing run since those March lows back in 2020. Going from the March lows in 2020 to the November 2021 highs, shares of Simon Property Group have returned a mere 190%. However, since those highs, the stock is now down 40%, and 34% of that loss has been during 2022. Malls are grouped into different classes, from A+ being the highest to D being the lowest quality. Ratings are based on retail sales per square foot. When all the news broke out of malls dying 5-10 years ago and shutting their doors, even some today are still dying, many of those were C and D rated malls, not A-rated malls, which is exactly what Simon Property Group is. They are an A-rated mall with retail sales much higher than any of those other malls. Occupancy during the most recent quarter was 93.9%, which was actually an uptick from prior year. Revenues also saw a tick higher, as did NOI. All that and add in these encouraging signs and things are pointing up for the company. We saw another round of guidance revisions to the upside, and we got another dividend increase. That is 2 consecutive quarters of dividend increases for the company. In Q2, we saw a 3% dividend increase, and more recently, we saw a 2.9% dividend increase. The company was forced to cut its dividend, and this can happen to REITs or any dividend stock when times get tough, but they were forced to cut their dividend in the middle of COVID back in 2020, but since then, they have increased the dividend 35%. Investors currently earn an annual dividend of $7 per share. That equates to a dividend yield of 6.7%, by far the highest among the 3 REITs that we're looking at today. But they also have a payout ratio of 6.9%, suggesting the dividend is plenty safe right now and has plenty of room to keep growing. In addition, the company has a fortress balance sheet with a credit rating of A-, making it one of very few REITs with an A-rated credit rating. By far the highest quality among the 3 REITs as well. In terms of valuation, shares of SPG trade at a price to AFFO of only 10.9 times, with a 5-year average of 14.5 times, meaning currently we are 25% below our normal level. So to recap, for SPG, you get an A-rated portfolio, a strong management team, guidance increasing, dividends increasing, low payout ratio, low, cheap valuation. Is it all priced in? Who knows? It could be anyone's guess, but just some of my thoughts when I'm looking at companies during my research. So there you have it, folks. 3 high-quality REITs with bright futures that have stood the test of time, all have great management teams, growing dividends, but they're all trading at a cheap valuation. If you're a long-term investor and you're looking for these opportunities to set your portfolio up for the long term, you may not get the exact bottom, but you know you're getting a cheap valuation, and this could be a very ideal time for those patient long-term investors. Now, if you could do me a huge favor before we go and click that like button down below, that would be huge for the growth of this channel moving forward. I put out all of this information for free to try and help you on your investing journey. So it would be greatly appreciated if you could do me a favor and click that like button. And with that being said, I hope you enjoyed the video, and we will see you next time. Take care.